This is our Forex blog for April 13th, 2012. And like we do most days, we want to buy the strongest currencies versus the weak and sell the weakest versus the strong. We statistically compare every currency to every other one using multiple time frames and different statistical methods. The dollar and the yen are the two pairs that most people trade. The histogram on the top is made up of 5 of our best tools we've come up with over the last 6 years. 3 of them measure the direction, what percentage of dollar pairs, for instance, are going up or down, and the other 2 measure the intensity of direction. So we average those together into one very easy to read indicator. If you see a lot of strength followed by the pullback move, visually showing about half of the weakness that the previous strength had, then the trend's more likely to go back up. Underneath that, we have the daily, weekly, and monthly trend. If you see real-time momentum up, followed by a little bit of a pullback with half the weakness, and the daily, weekly, monthly trend is up, it's even more likely to go up. So, you can still trade if you see some strength today, but the daily, weekly, monthly trend are down, you can still trade it, but be aware that usually, like you can see here, it had about 40 minutes of strength, 20, 30 minutes of weakness, 10 minutes of strength. In other words, if all the time frames are up, like in the New Zealand, you can see at 4 right here, for the most part, from 4 to 7, with minor 15 minutes of weakness here, 1 5-minute bar of intense weakness here, 20 minutes of weakness here. Pretty much the entire time it was up. The CAD daily trend is up, the weekly and monthly trend's down. A lot of traders run into issues. Everyone knows you're supposed to trade with the trend, but what trend? Do you trade with the real-time trend, the daily trend, the weekly trend, the monthly trend? Sometimes all the trends line up, like the Swiss. Weakness across the board. Euro, weakness across the board. Trade those against whatever's strongest at the time. The yen today, the dollar for most of the day. The yen has a very strong weekly and monthly trend that's up. So even though the daily trend, shifted down, mainly because of, incredible weakness from about 7 o'clock yesterday onward, the daily trend shifted down. The weekly, monthly trend's still up, so that trend can very easily change direction. It's very safe to assume that today's trend, if you see some real-time momentum coming in, it's going to shift the daily trend up, which it did at 4 till about 5, and then again at 10. So trade that yen against the weakest euro and in Swiss. So you want to sell the euro against the yen, and guess what? Pretty much all day you focus on selling this. It went down 20, 30 pips, pull back up to the hourly, it couldn't get above it. Initially it was very strong, but then when it had this little mini double top right here, you can see the strength is half as much as it was before, and notice it fell from around 106.70 all the way to 105.80. Almost a 90 pip drop. Notice our intelligent trailing stop, got you out right there. For those of you who are shorter term traders and like to get in and out, have very small amounts of pips risk, you can use our range chart. This is a 6 pips per bar chart, and you can see the exact same pattern here, a little mini double top with 30% less strength than before. The momentum was obviously the downside. You get short every time the trailing stop gets hit here at 62, and you're out at 48. You made about 12 pips. Short again here at 37. Out here at 07, you made 30 pips. And keep in mind, 10 pips per day doubles your account every 2 months. It doesn't take a whole lot of pips as long as you increment your number of lots as your account grows. $2,000 account getting 10 pips per day, that's 50 a week, 200 net per month. You might make 500 pips during a month on winning trades and lose 300 pips on your losing trades. So you net 200 pips a month. It breaks down to 10 pips a day. $2,000 account every pretty much 2 months, doubles. 2 more months, doubles. And you can see by the power of compounding, 10 pips per day can turn a $2,000 account into $258,000 in a year. Now, obviously, at the end of the year, you're doing 51 full lots. That's $510 per pip. So basically, the point is, if you net 10 pips per day, you do very well trading. And you might get to a point where you're doing 10 or 20 full lots per trade, and you hit a psychological barrier, and it just makes you nervous. $100 to $200 a pip risk, might just be more than you can handle. I've seen it happen with a lot of traders. Personally, I don't like to go over 30 lots myself. A lot of trades, if I don't believe in it, I'll only do 5 or 10 lots. Everyone's different. A lot of people trade for income. At the end of the month, you take the money out of your account, you put it in longer term investments and so forth. But the point is, 10 pips per day is a decent amount, a good rule of thumb to start with, and then your goal should get to 20 or 30 pips per day net. And you might only need to trade 2 or 3 days a week in order to hit your goal. So let's look at the currency meter for some other trades that you would also find. Again, the Swiss, very weak. The yen, strong. Let's take a look. Okay, it happens to already have this one up. Swiss yen, you're basically looking for sells, small profit, 10 pip drop here. Notice fell from 69 all the way down here to 99. It's about a 70 pip drop. And our intelligent trailing stop does a really good job of getting you out at the proper time. And usually when currencies are underneath the hourly, they're more likely to go down. When they're above the hourly moving average, more likely to go up. You can see the daily trend shifted down here, and then also down again at 8 o'clock right here, it shifted down, 8:05 right here, and that trend continued. The New Zealand is also extremely strong, so you could have traded the weak euro and Swiss against the New Zealand. Weak euro, strong New Zealand. That means it's going to go down. You have this nice, beautiful pullback right here where it fell. And notice the trailing stop got you out here. Usually what I do, I don't use the trailing stop on 5-minute charts. Most of the time I use range charts. I will draw a trend line underneath there. And I never get short when a sideways move breaks the trend line. But if a sideways move breaks the trend line, I will sell it 1 pip underneath that bar's low. So I would have actually gotten short here at 58.61 with my stop just a pip or two above the high. And you can see you always want to draw your fibs on that. I usually, the majority of the time, exit half my trade at the fib target and then put my stop above those bars high or hit the trailing stop. The fib target in this case got you out almost at the perfect time, and you made the most number of pips. You can see it fell down about 20 pips. So if your goal is 15, 25 pips a day, you made it on this one trade right here. The New Zealand was strong, the Swiss was weak, so that means you want to buy the New Zealand Swiss. And notice, this pretty much trends up all day long. You can, I don't have the range chart on here, but you can just simply wait for a pullback, wait for a break of the trend line, or wait for it to go 1 pip above the previous bar's high that breaks the trend line. In it, you bought this at 75.75. Your stop is just a pip or two underneath here, 75.71, and most of the time it's going to work its way up to the fib target. If you want to use that to get out of the trade, you can. And you can see the key to trading is small losses, big wins. This is your potential profit right here. I'm just putting that on there to see it visually. This is how traders should think. This is your stop. We'll compare these to each other, and you should really focus on taking trades that will give you 1.5 to 2 times bigger wins than what you're risking. This is a trade that's very likely to go up. You can see the real-time momentum is to the upside. It's above the hourly moving average. This dotted green line right here is the previous day's high. So it's above yesterday's high. That's a major sign of strength. A lot of people would have bought this pullback right to when it touched the previous day's high in the hourly moving average. Just as a cluster of support. Support resistance clusters tend to be very, there's people that buy the previous day's high. There's people that buy and have buy orders placed at the hourly moving average. When multiple areas of support are at the same area, it's more likely to go up, and you can see it did. But nonetheless, on this last trade right here, you can see your likely profit target. There's a good chance of it happening. Notice the move up here had more than 2 times more momentum to the upside than the weakness on the way down. That's a very high probability trade. The daily, weekly, monthly trend is as strong as you really can get it. You're buying one of the strongest currencies versus the absolute weakest. No one wants the Swiss. Everyone wants the New Zealand. And, this is your fib target. Fib targets are even more likely to be hit when you have all the time frames lined up like this. It's pretty much a no-brainer. So you get in, you get out. You might have also decided to buy this next pullback. And when it starts to get above our upper containment bands, it reduces the odds of the next fib level getting hit. This is off that next wave. You can see it just came a pip, maybe a pip underneath it, didn't quite make it. But again, you're in this trade probably, it broke the trend line right here, 75.81. Your stop is underneath the low here. It's possible you might have gotten stopped out of this with a loss and had to get back in. But if that's the case, you know, the win was maybe 80% bigger than the loss, so you were still left with pips. And when it gets up to the fib target and above or upper containment bands and you see the momentum kind of dying out, you can also look for counter trend trades. Usually they will work their way back to the hourly moving average right here.